Yo, welcome back to Infant Investors, the home for all new and non-investors. I'm Curtis, and today we've got part two of the recession videos. And today I'm going to be talking about the 7 recession investment strategies. Look, before I get into this video, I want to just talk about the recession straight off the bat. A recession is never ever a good thing. Obviously, naturally, during a recession, there are job losses, livelihoods are being negatively impacted, and some people do endure a worse financial situation. So, right off the bat, I want to say that a recession is never actually a good thing. And I create this video with extreme, what's the word I'm looking for? Vigilance and care to the fact that all of your financial situations are different. There is no one size fits all approach, and you all are going to have to work out what is best for you on an individual case by case basis. So if you are worried about the recession, then my only advice to you would be to seek financial advice, whether that's an individual financial advisor or just doing your own research to try and work out what is going to be best for you in this current situation. However, on the other hand, I often say if we both look at a pound coin, you might see the queen's face and I'll see 3 lions or whatever's on the tail side, meaning the same situation from a different perspective does become a different situation. And, from an investor standpoint, this can become an opportunity. From an employee standpoint, it could be a bad thing. From maybe a consumer standpoint, it might be a good or bad thing depending on what you're consuming. But from an investor standpoint, this can be an opportunity, providing all of your other economic, family, social factors aren't negatively impacted. So if you are watching this video, this means you are open to the idea that the recession can present significant opportunities to generate wealth. And to be honest, for lots of you new investors, it's kind of better that this happens now, early on, so you can learn from it, learn how to deal with it. And so better than it happening in the next 5 years after just say a boom of 5 years, and you lose everything you've made in 5 years time and you're sort of feeling a bit down from that. It's better it happens early on. You can learn from it, maybe leverage it as an opportunity to get a lot more shares, and then hopefully it can bode you well in the future when this situation does occur. And it will occur again, because the economic market is a very cyclical market, and so things just come back around again and again in a circle. So yeah, I just wanted to put out straight from the bat, a recession isn't a good thing. But if you are watching this video, you are watching it on the basis that you see that this could be an opportunity from an investor standpoint, and you're willing to learn all of the different types of things you could potentially do in order to try and maximize this opportunity. So I start this video with the quote from Baron Rothschild, which is obviously, one of, if not the richest family in the world. When there's blood on the streets, you buy, even if the blood is your own. And, Baron Rothschild made a killing during the war. I think it was the Napoleonic War or something with France or something like that. And when everyone was running scared and the markets was running scared, he just bought everything. And that was apparently one of the ways he generated so much wealth, and why the Rothschild family is one of the richest families in the world. So today's video, the 7 recession strategies. If that's what you want to know, please like, please comment, please subscribe. I'm on a mission to get to 2,500 subscribers and get the world of investing out to more people in a clear, simple and transparent manner. But first, let's get straight into this. So let's recap yesterday's video. We talked about Germany experiencing their first quarter of negative decline. We talked about the third inverted yield curve in the UK. We talked about the US having their inverted yield curve. We talked about how the trade war is impacting exports in Germany, and there's a domino effect across the whole market. We talked about a lot of things that are really signifying that a recession is occurring and on its way. So again, I'm making this video on the presumption that you are clear that there is a strong feeling in the market that a recession is pending and on its way. And to be honest, I'm going to cover this in my portfolio update tomorrow, but it is definitely here. It's definitely coming. I mean, I put some money into the market yesterday or 2 days ago because I put £500 in just to buy 3 stocks because of their ex-dividend dates. and I wanted to get a little bit more money in terms of the dividend payment that I expect to receive in September. And that £500 is gone. Like, the balance I've got in my investment portfolio now is less than what it was when I added the £500. And so what that basically means is the market is just literally swallowing up cash. And to be honest, I didn't really want the £13 28p extra dividend payment. I didn't want it that much, not for £500. Do you know what I mean? Like, if it was 20 quid, maybe £100, I could live with it. Like, I'm gonna get an extra £13 and it cost me £500 to do so. The markets right now is absolutely swallowing money like a vacuum, like a Dyson Hoover, and it's holding no prisoners. So, you know, right now I think it's very, very volatile. I know a lot of you guys are seeing reds in your portfolio, and I expect that to continue for a lot longer. However, this can be an opportunity to make some money. So what I've got on my screen today is a link from Investopedia, and this talks about contrarian investing, which is going against the crowd, which is often something that people do in order to try and benefit within the market. So I'll put the link again in the description. But my main focus is this link, which is an investment portfolio strategy during a recession. Now, there are some points that I've got that aren't going to be in this article, and there are some points that I've got that are going to be backed up within this article. So I'm going to go through all of my strategies, all of the points, and then where it relates to this article, I will talk about it, and where it doesn't, I will talk about it from a different perspective anyway. So the first of 7 investment strategies is to do nothing. Number 1 is to do nothing. Number 1 is to keep your current strategy, and whatever it is that you do, continue doing that. So if you invest £100 on a monthly basis, continue to invest £100 on a monthly basis. If you invest, I don't know, £50 a week, continue to invest £50 a week. If you put a lump sum and you put a lump sum at 2 times a year, continue to put a lump sum 2 times a year. One strategy that a lot of investors have spoken about is they do not act any different during the time of an economic crisis. And the real genuine reason behind that is because they've got an extremely long-term view. And when you have a long-term view, you understand there's always going to be peaks and troughs. There's always going to be dips. Even in bullish markets, there are always going to be dips as well. And so you're not really trying to react to every single situation. Please remember that a recession might only last for a couple of quarters. It might last for half a year. It doesn't have to last for, say, 2 years or a year and a half or something really significant. And so in that instance, if it's only going to last for potentially a short period of time, why change and revisit your whole strategy? So option number one in the list is to do nothing and to keep your current investment strategy. Number 2 is about diversification, and here I'm going to go to a section within this article. Diversification still matters. That said, it's dangerous to pile into a single sector, including customer staples. Diversification is especially important during a recession when particular companies and industries can get hammered. Diversifying across asset classes such as fixed income, bonds, and commodities, in addition to equities, can also act as a check on portfolio losses. Fixed income recession strategy. Fixed income markets are no exception to the general risk aversion of recessionary environments. Investors tend to shy away from credit risks such as corporate bonds, especially high yield bonds and mortgage-backed securities, since these investments have higher default rates than government securities. As the economy weakens, businesses have a more difficult time generating revenue and profits, which can make debt repayment difficult and, in the worst case scenario, lead to bankruptcy. As investors sell these risky assets, they seek safety and move into US Treasury bonds. In other words, the prices of risky bonds go down as people sell, meaning the yields on these bonds increase. The prices of Treasury bonds go up, meaning their yields decrease. What I'm referring to here is hedging, effectively. One strategy number 2 is to hedge, and to hedge with commodities, to hedge with bonds, aka fixed income, to hedge with even cryptocurrency, which is a commodity. What tends to happen in these markets is that the commodities markets and the fixed income markets acts as a mirror in some instance to the equities market. So when we're talking about a recession, generally speaking, the equities market is the most heavily affected, the most heavily impacted market. We're talking about stocks of companies that generally start to decline, generally start to tank. So in that instance, diversifying in a different asset class can be a way not only to protect your losses, but actually see some growth within that period of time. So investing in gold, investing in silver or other commodities, also investing in currency such as cryptocurrency and Bitcoin can be a way to hedge. And I will not be surprised if Bitcoin starts to soar during this recession. That is not going to come as a surprise to me. I would love to invest in Bitcoin. I just think it's too high at the moment to get a whole coin. However, it's definitely a possibility. And invest in bonds. And specifically here, we're talking about government bonds. We aren't talking about corporate bonds. Corporate bonds tend to have higher yields, but they tend to be riskier because of the C word, corporate bonds. They are company debt. And if companies are in situations where, they have a lot of debt, they aren't getting as much revenue from customers, aren't getting as much profit, much margin from customers, then they might struggle to repay their debt, which is what this article is saying. So what we're talking about here is government debt, which tends to be lower yield, but can be a form of protection during the recession. So number one is to do nothing, keep your current investment strategy. And number two is to hedge, whether that's gold, bonds, cryptocurrency, effectively diversifying by asset classes. Number three, in terms of investment strategies during a recession, is to stop investing and to stockpile cash. Effectively, what we are talking about here is timing the market. Now, there is a quote that time in the market is better than timing the market. And effectively what we're saying here is just being in the market, just buying stocks is much better than trying to time the dips and time, the peaks of any individual equity or ETF or stock or market, etc., etc. But what we're saying here is that during a time of a recession where we know that for a significant period of time, whether it's 3 months, 6 months, 9 months, 12 months, 18 months, we know that the market potentially is going to have a downturn, then rather than continue to invest, what some investors will do is to stop investing, save that money into cash, stockpile cash, and when they feel like the bottom of the recession is here, and to actually find the bottom is pretty much impossible, but what you might find is that the news and the sentiment in the market starts to be a bit more upbeat. Maybe you see the first quarter of GDP growth and people are like, oh, actually we're coming out of the recession now, things are looking up, people are buying more houses, whatever the consumers are spending more, whatever the metrics are that the government starts to say that, look, we're going back in the right direction, then you start to get a feel of actually things are maybe have bottomed out now. All of that money that I saved in a normal savings account, I'm going to now put that straight into the market because I feel that this is the bottom, and hopefully I'm going to ride it out into, the top. Well, hopefully, as you want it to grow effectively. What this is called is investing for the recovery. So this article talks about it here. So what about when the economy begins to recover? Just as in a downturn, during a recovery, you have to keep an eye on macroeconomic factors. One of the tools the government uses most frequently to reduce the impact of a recession is easy monetary policy, reducing interest rates in order to increase the money supply, discourage people from saving and encourage spending. The overall purpose is to ultimately increase the economic activity. One of the side effects of low interest rates is increased demand for higher risk, higher return investments. As a result, equity markets tend to do very well during economic recoveries. Some of the best performing stocks use operating leverage as part of their ongoing business activities, especially as these are often beat up during a downturn and become undervalued. Leverage may also hurt during a recession, but it works well during good times, allowing firms to take on debt to grow faster than companies that don't. Growth stocks and small cap stocks also tend to do well during economic recoveries as investors embrace risk. So what we're talking about here is once things have bottomed out, once the downturn starts to feel like, it's kind of at its end and we're at the recovery stage, some of those higher risk equities, some of those growth stocks, some of those really significantly beaten down, trodden on, undervalued stocks of great businesses but have just been absolutely battered during a recession, is now a potential opportunity to invest, as it's going to be a recovery cycle. We're now in a time of recovery. So that is also another opportunity. So number one, do nothing. Keep your current strategy. Number two, hedge, whether it's gold, bonds, cryptocurrency, effectively diversified by asset class. Number three, stop investing, stockpile cash, time it for when the recovery is happening and put your money in during the recovery. Number four, in terms of recession strategies, is to buy recession-proof stocks. So what is a recession-proof stock? And this article does talk about recession-proof stocks. Now, before I read this, recession-proof stocks effectively is stocks or companies that either one of two things happen. People either don't, it's never really negatively impacted by a recession because it's a necessity, such as consumer goods, or alternatively, people flock to those stocks. I didn't mean to rhyme there, but they flock to those stocks during a time of recession. And I've heard things like McDonald's being a stock that people flock to because it's a time of recession. People apparently, generally, they eat less healthily. So because they eat less healthily, they eat more fast food. If they eat more fast food, McDonald's actually sees a lot more profits during a recession time, which when you actually break it down, you can potentially notice that. Let me give you a story. You guys know that I've worked in banking and I love to give you stories from my time in the bank. I'll give you one specific story which happens time and time again. When customers have lost their job and they come and see me when I was in the bank and I had to help them with their finances and tell them, what they need to do with their money, where they need to cut back on their budget, and help them to try and make the most of their financial situation, there are two things that these customers never ever cancelled, no matter how expensive it was towards their budget. Those two things are, one, cigarettes. Customers never ever stop smoking or reduce smoking. Generally speaking, they smoked more. So a recession-proof stock would technically be a tobacco stock. Now, there is an ethical aspect to that, and that's for you to kind of work out from your own moral compass standpoint whether that's something you want to invest in. But I'm just here to give you the facts, and that's for you to kind of take it away. People never stop smoking during a recession, and actually people, when they lose their job and when things are negative, they actually tend to smoke more. So you can actually see that profits will rise in that situation, similar to the way that profits might rise in a McDonald's situation. The other thing that people never cancel, which you'll probably think is crazy, is their Sky bill. They never cancel Sky. They keep Sky, and it might be the full package, full entertainment, movies and sports and HD and 4K and multi-room, and it might be like £91 a month or £110 a month, and they will keep it. They will never ever cancel their Sky bill. They will cancel everything under the sun. Little Julie's violin lessons, Little John's tennis club lessons. They will cancel all of that. They don't give a crap about tennis or violin, but they will not cancel Sky. They will not cancel, watching channel 237, Trucks Gone Wild or whatever shows are on Sky at the moment. They will always maintain those two things. And it's really, really important that you understand people's buying patterns and buying behaviors. So what this is about, option number 4, is buying recession-proof stocks, is effectively buying stocks that people either don't live without or they flock to during a time of economic crisis. Let's get into this. When invested in stocks during recessionary periods, the relatively safest place to invest are in high-quality companies that have long business histories. McDonald's would definitely be one of those situations, because these should be the companies that can handle prolonged periods of weakness in the market. For example, companies with strong balance sheets, including those with little debt and healthy cash flows, tend to do much better than companies with significant operating leverage, debt, and weak cash flows. A company with a strong balance sheet and cash flow is more able to handle an economic downturn and more likely to be able to fund its operations despite the tough economy. By contrast, a company with a lot of debt may be damaged if it can't handle its debt payments and the cost associated with its continuing operations. While a company's fiscal Probity is important. You still have to ensure it is not cutting costs in the wrong areas. A market sense study of 101 household brands' performance during the 1989 to 1991 recession showed that increased ad spending raised the sales of the following brands' products: Jif peanut butter, Kraft salad dressing, Bud Light beer, Coors Light beer, Pizza Hut, Taco Bell. Brands that neglected marketing, on the other hand, saw their sales drop steeply. These brands included, but were not limited to, Jell-O, Hellmann's, Doritos, Green Giant, and McDonald's. Historically, one of the safer places in the equity market is consumer staples. These are typically the last products that a household removes from its budget. By contrast, electronic retailers and other consumer discretionary companies can suffer as consumers put off higher end purchases. If we click on consumer staples and find out what that is, consumer staples are essential products that include typical products such as food, beverage, household goods, and feminine hygiene products, but the category also includes items such as alcohol and tobacco. These goods are those products that people are unable or unwilling to cut out of their budgets regardless of their financial situation. So this is what I mentioned. There are things that people do not want to cut out of their budgets regardless of their financial situation. They will grind everything else out, but they will maintain certain things. Now, in certain situations, you have to eat, you have to drink, you have to have feminine hygiene products, you have to have certain household goods. Those things are understandable. So when you've got companies like, I don't know, Unilever, or, other companies that have general household goods that people are going to need and require during a recession, and they're big established staple companies, those are companies that we consider recession-proof stocks and potentially good investments during a recession. So number 4, recession-proof stocks. Number 5, in terms of strategies during a recession, is to sell all and to sit it out. Sell all and sit it out. Now you're thinking, is this the same as stop investing, stockpile cash? No. Stop investing means to hold. You hold what you've already got there, you stockpile cash, you wait for the recovery, and then boom, you put that money in, you slide that money in, and you hope that that recovery bounce back. Number 5, what some investors do is they sell everything and they sit it all out. They just sit the recession out. They have nothing to do with it. Maybe they use their money to start a business. Maybe they use that money to do something else with their life or their finances. I've seen many instances where people have come to me when I used to work in the bank during a recession. They've been made redundant and they've just used that as an opportunity to go traveling. Now you might think, how am I making money during a recession if I'm traveling? Well, at the end of the day, we always talk about investing in yourself. And maybe that you can use a recession as an opportunity to sit it out, not really worry about the market lows and highs, take whatever money you've got in whatever situation you might, and try and make the most of it from your own personal livelihood standpoint. So number 5 is effectively just sitting out the recession entirely, not even worrying about it, not even thinking about it, just focusing on work, your family, whatever passions or interests that you've got, and using your money to, benefit your life in some other way. And what often happens, and what I've seen many times, is people use that money to start a business. They try and start a business during recession, particularly the 2008 crisis, because so many people lost their jobs, and what they didn't want to be is dependent on a company anymore for employment. So they used that money, the redundancy money, and rather than invest, they invested in their own business, their own venture. They sat out the recession completely. They used that money to invest in themselves, and hopefully, they benefited from that. So that is also an opportunity to benefit during a recession, and that is also a recession strategy. Number 6, in terms of the strategy. So just to go back, number 1, do nothing. Number 2, to hedge with cryptocurrency, gold or bonds. Number 3, stop investing and stockpile cash. Number 4, buy recession-proof stocks. Number 5, sell all and sit it out. Number 6 is to keep buying more. Keep buying more. This is effectively the contrarian. This is the contrarian approach. This is the approach that while everybody is doing the exact opposite to what you're doing, that is the way you're going to make money in this recession. If everybody is selling, you keep buying. Even though you might buy, and in the instance like me, Dyson came and just swallowed up all of my money, just buy again. If you've got the money, if you've got this disposable income, if you've got, the amount that you're saving, just keep buying. Keep buying, buying, buying. If you have more, buy. What this game is about in this scenario is the volume of shares. You are primarily focused on getting the most units of shares possible. And so you're just going to keep buying. If, for example, the share price is $1, and you normally buy £100, obviously that's 100 shares. Now it's dropped to, I don't know, 50 cents. You're now getting it for 200 shares. The next week it drops to, I don't know, 25 cents. You're now going to get 400 shares. Effectively, what you're just doing is increasing the actual amount of shares, because at the time it does recover, if it is undervalued, if it is a good, worthwhile stock, you will have a huge number of shares that you otherwise would not have had. And when that market does bounce back, that is your opportunity to incredibly and significantly capitalize on this recession. So number 6 is to keep buying more. When there's blood on the streets, you buy, even if the blood is your own. Even if you spend £500 just for 13 quid and Dyson takes all of your money, it doesn't matter. Just keep buying. If you have the financial ability to keep buying, that is your approach. So number 1, do nothing. Number 2, hedge. Number 3, stop investing. Number 4, buy recession-proof stocks. Number 5, sell all and sit it out. Number 6, keep buying more. And number 7 is to short the market. Short selling. For those of you that don't know what short selling is when you bet the market will fall, and instead of buying shares for the stocks to rise, you buy shares with the intention that the stocks will fall, and the more that they fall, the more money you make. Now, for those of you investing with free trade, you do not have the ability to short sell. Short selling is not a capability that sits within the free trade application. You have to go to other investment platforms, other trading platforms in order to do this. So for example, I use eToro as well as free trade, and with eToro I have the ability to short sell because I'm not buying stocks, I'm buying CFDs, which is a contract for difference. It's a form of derivative, and it allows me to trade the price of a security rather than the actual security itself. And what that means is that I can either make a buy order, which means I want it to rise, or I can do a sell order, which means I want it to fall. And if I do a sell order, that means I am shorting the stock and I want that stock to reduce its price. And there are heaps and heaps of scenarios and people that have made so much money shorting. If you think about the last 2008 crisis, I don't know if any of you guys have watched the movie The Big Short. If you haven't watched the movie The Big Short, go and watch the movie The Big Short. Curtis recommends you to go and watch that movie, The Big Short. That movie is a phenomenal movie. It's like Wolf of Wall Street, but it's about the last global recession, the last global crisis. And it's about when certain stock market investors saw that all of these mortgage-backed securities were just full of, crap mortgages, effectively packaged as AAA rated mortgages when they really weren't. What they did is they went and shorted the market. Some people are still shorting it, and they made an absolute killing. There was another documentary on Netflix around the healthcare sector. I can't remember, healthcare or something. And the woman that's presenting it, she's been shorting a lot of healthcare stocks, which has done, incredibly poorly during that time. And she's talking about made, a 6 figures shorting the market. So if you know what you're doing, again, you have to know what you're doing. I would do your own research. If it's something that you're not familiar with as a concept, do your research to try and understand it. But another way you can make market during a recession is shorting, because generally speaking, if the market is going down and we know that it's going to go down for a sustained period of time, that is the same opportunity as a bullish market when it's going up and you're buying. So effectively it's a bearish market and you are buying in the hope that it actually falls. So just to recap on the 7 strategies: number 1, do nothing, keep your current strategy. Number 2, hedge with gold, bonds or cryptocurrency, diversify by assets. Number 3, stop investing, stockpile cash and time for the recovery. Number 4, buy recession-proof stocks, stocks that do well during a recession, such as household goods, feminine products, McDonald's, tobacco, alcohol and Sky. Number 5, sell all and sit it out. Invest in your own business, invest in yourself, travel, just enjoy your money and don't even worry about the recession until it's time to get back into the market. Number 6, keep buying more, the contrarian style of investing. When there's blood in the streets, you buy, even if that blood is your own. And number 7, short the market. Find an investment application that allows you to short stocks and short the market while it's dropping and make money during the down cycle as well as the up cycle. Guys, I know this is a long video. I know that we're past 30 minutes, but I really sincerely hope you found this video informational. It's not even a word, guys. It's not even a word. It's just not a word. I hope you found this information useful. I'm coining informational. I hope you found this informational, and I hope you found some key nuggets of information that you can take away and hopefully apply to your situation. I will recap what I said at the beginning. Always do your own research. A recession is never a great thing, generally speaking, in the economy, but from an investor standpoint, you can try and turn these negative situations into an opportunity, with the right type of thinking and the right type of mind frame. So I really hope you found this video beneficial. If you did, please like, please comment, please subscribe, help the channel grow to 2,500 subscribers. Share it with anyone that you think might find this useful. And hopefully, you guys do really well in a recession. I really want to hear, some of your strategies in the comments. If you've got any strategies that I haven't mentioned in this video, please put it in the comments and let everybody else see so they can benefit from it as well, so I can benefit. And moreover, I really hope that you guys do well during this recession when it does come, because it does feel like a probability now. It does feel like something that is a bit more a surefire. So yeah, I hope you found this video useful. Please like, please comment, please subscribe, and I will see you next time with another investment video. In fact, I'll see you tomorrow with a portfolio update. So take care, enjoy your weekend, and I'll catch you guys tomorrow. Other than that, peace. Happy investing, guys.